Welcome back to the Deep Dive.
Great to be here.
Our mission today is, well, it's all about context. And for any of you out there currently tackling the ACCA financial management syllabus, this is a deep dive you really can't afford to skip.
No, absolutely not. We're looking at Chapter 2, the financial management environment.
And it's one of those, isn't it? It looks straightforward on the surface.
It does. And that's the danger. This is one of those sections that students, they tend to dismiss it a bit too quickly.
Because it's not packed with calculations.
Exactly. It appears light on the numbers, so they flick through it. But I really cannot emphasize this enough. This chapter is the conceptual bedrock for all of the heavy-hitting calculations that come later.
You're talking about WACC, NPV.
All of it. Your weighted average cost of capital, your net present value evaluations, your risk management strategies. Look, if you don't master the environment, your numbers might be academically perfect, but in the real world, they'll be practically meaningless.
Okay, so let's unpack that critical link right there. We're always defining the financial manager's main jobs as 1, raising long-term finance, and 2, making profitable investment decisions.
Right.
And those decisions are just not made in a vacuum. So is the mission here less about listing market parts and more about understanding how the real world actually influences the mechanics of finance?
Precisely. That's the word. Mechanism. The environment is the mechanism. It's what dictates the cost of your capital, the timing of your share issues, the pool of funds that's even available to you.
Mm-hmm.
Think about it this way. If you don't really grasp how efficient or inefficient the stock market is, how can you possibly trust the share price you're using to calculate your cost of equity?
You can't. It's just a number at that point.
It's just a number.
Hmm.
Or, if you don't understand why the yield curve is shaped the way it is, you could easily risk locking your company into an unnecessarily expensive long-term loan.
So we're aiming for application. It's about linking these things, market mechanics, efficiency, interest rates, directly to what a manager actually does.
That's the goal. High-level, strategic, managerial actions.
So we should be really clear with everyone listening. This is a major written, applied testing chapter. The examiner's not interested in you just listing definitions from a textbook.
Not at all. They want to see you take an environmental fact, let's say the existence of the alternative investment market, and connect it directly to a consequence for a smaller, growing company that's trying to find capital.
That's the crucial distinction then.
It is. You have to be able to explain, say, how the market structure dictates where a company should go to raise its finance, or why an inefficient market forces a manager to be cautious about using the current share price as a true reflection of the company's value. We are moving past the what's and really digging into the why and the how.
Okay, a great place to start then is right at the beginning. The basic infrastructure that lets finance flow at all. The plumbing of the financial system. We're talking about financial intermediaries, things like the big clearing banks, the fund managers. What are the essential roles they play in, getting money from millions of individual savers to the big corporations that need these huge chunks of capital?
They perform 3 functions that are so fundamental we almost take them for granted. But honestly, without them, our capital markets would just seize up. The first one is aggregation.
Aggregation, so grouping things together.
Exactly that. Just think about the mismatch in scale. You, as an individual, you might put, 500 pounds in your savings account?
Right.
But a big car manufacturer, they might need 500 million pounds to build a new factory. An intermediary, like a bank or a pension fund, takes countless small individual deposits, the 500s, the 5,000s, and it consolidates them. It aggregates them into the huge company-sized loans or investments needed for major projects.
They bridge that massive gap.
They bridge the gap. They turn, as you said, small drips into a usable flow of capital.
So aggregation is about scale. But the second function, maturity transformation, that feels a bit more complex and historically a lot riskier too.
Oh, it is. It's absolutely critical for long-term corporate investment. And you are spot on. It carries significant risk. Think about it. Most of us as depositors, we want relatively short-term access to our money.
Sure. I want to be able to get it out if I need it.
Of course. You might keep funds on deposit for a few weeks, a few months, maybe a year in a fixed account, but companies, they need loans to buy land, to build factories, to develop new technology. These are investments that often need capital locked up for 5, 10, maybe 15 years.
So the intermediary is taking in short-term money, its liabilities, and lending it out long-term as its assets. How on earth do they manage that risk? That seems like a fundamental mismatch.
Well, they rely on statistics, really. They work on the probability that while a few individuals will definitely withdraw their cash today, many, many others will deposit new money or just leave their existing funds untouched. They manage the overall liquidity of the whole
Oh,
pool.
I see.
And this transformation is just crucial. Without it, companies would never find long-term financing. Individual savers are just too risk-averse, and they're too focused on the short term.
So that risk, the liquidity risk, that everyone might panic and demand their cash back at the same time or run on the bank, that's essentially outsourced to the intermediary to manage.
It is. And we saw in 2008 what happens when confidence in that system breaks down. The whole thing just locks up because that transformation function suddenly becomes suspect. Everyone thinks the long-term loans can't be sold fast enough to pay back the short-term depositors.
A very high-stakes reality check.
Absolutely. But when the system is stable, this function is the lifeblood of infrastructure and corporate growth.
Okay, and the third function?
The third is diversification of risk. Again, just think about it from the perspective of an individual saver. If you took all your life savings and lent them directly to a single promising startup.
The risk would be enormous.
Yeah.
Catastrophic if it fails.
Exactly. Total loss. But an intermediary, a bank or a fund, it lends or invests that huge aggregated pool of capital across hundreds, maybe thousands of different borrowers, different industries, different countries.
So by spreading the capital out, the bank reduces its own risk. And by extension, it reduces the risk for me, the individual whose money they're using.
Precisely. You, the lender, you accept a lower but a much, much safer rate of return because you're insulated from any single investment failing. If one company defaults, the overall return on the fund is barely affected because the capital is spread so thinly.
Right.
So without these intermediaries managing aggregation, transformation, and diversification, the whole process of financing big, long-term investments would be, well, incredibly clumsy, hugely risky for individuals, and massively expensive for companies.
Okay, so if that's the plumbing, let's move on to the marketplace itself. The bedrock of long-term corporate finance, the stock exchanges and the broader capital market landscape.
Yeah.
What are the key services they're providing to a financial manager?
Well, the primary function is really twofold. First, they have to ensure there's a fair, orderly, and efficient marketplace where ownership securities, shares can be transferred easily between investors. That liquidity is key.
And the second part?
The second part is that they provide the venue where companies can raise new capital. That's the primary market function, issuing new shares or new long-term debt.
You know, that liquidity point is so often underestimated. If I buy shares in a company, I have to have the confidence that I can sell them easily tomorrow if I need to.
Yeah.
The exchange gives me that confidence.
It does. And that confidence is completely tied to regulation. The fact that exchanges are so heavily regulated isn't arbitrary. It's a mechanism to build trust, which in turn creates liquidity.
So why is that stringent regulation so necessary for a stock exchange to actually succeed?
It all comes down to market integrity. If investors think the market is rigged or unreliable, what do?
They pull their money out.
They pull their money out, liquidity dries up, and companies suddenly lose their source of capital. It's that simple. So the regulations are designed to enforce transparency and fairness.
How do they do that?
Well, they mandate that only suitable, financially stable companies are allowed to list their securities in the first place. And critically, they require that all information that's relevant to the company's value financial statements, press releases, big strategic changes, all of it must be made publicly available immediately.
The goal being that everyone is on a level playing field.
Exactly. The ultimate goal is to guarantee that all investors, whether you're a giant hedge fund or just an individual retail trader, you're dealing on the same terms based on the same information and at the fairest possible price.
So the red tape, the regulation, it's not a burden. It's actually the foundation of an efficient market.
It is. A fair, transparent, and efficient market will always attract a deeper pool of both domestic and international investment. And that, in turn, benefits every single company that lists there because it lowers their cost of capital.
Now, if we look beyond the main, big, highly regulated exchanges, the official lists, the capital market landscape is actually quite diverse, isn't it? It offers different options for different types of companies.
It does. And we're talking here about long-term funds, capital needed for 5 years or more.
Right.
And for smaller, growing companies, the sheer cost and the regulatory burden of getting onto the official list can be, well, prohibitive. It's just too much for them.
And that's where markets like AIM come in.
Exactly. That's why we have these specialized markets like the Alternative Investment Market or AIM. It's specifically structured to offer easier access to share finance for these smaller companies.
So what's the trade-off for a company using AIM instead of the main market?
The trade-off is that the regulatory requirements are lower, which means the listing costs are lower. And that makes equity financing accessible at a much earlier stage in a company's growth.
But there must be a downside for the investor.
There is. Because the regulatory framework is lighter, the risk profile for investors is generally seen as being higher. And what does higher risk mean?
A higher required return.
Exactly. Investors will often demand a higher rate of return on AIM shares compared to those on the main exchange. So the financial manager has to do a calculation. They have to weigh the lower cost of listing against the potentially higher cost of their equity capital.
Okay, and then if we step up to the really big international companies, the ones raising huge amounts of debt, we start talking about the Eurobond market.
Yes, and this isn't about shares anymore. This is about long-term debt. The Eurobond market provides long-term loan capital, typically for, say, 10 to 15 years.
And what defines a Eurobond? It's not about Europe, is it?
No, it's not geography, it's currency. A Eurobond is a bond that's denominated in a currency other than the national currency of the country where it's issued.
So a British company issuing a bond in US dollars, but doing it in, say, the German market.
That's a perfect example of a Eurobond. It allows these huge companies to tap into diverse pools of global liquidity, and they can often get financing on really favorable terms.
And why is that?
Because the market operates largely outside the national regulatory oversight of any single country, it's a very sophisticated tool for large multinationals to manage their debt profile and their currency exposure on a global scale.
Okay, let's zoom in a bit on the immediate market dynamics.
Yeah.
The things that determine the share price second by second. Valuation and speculation.
Right.
We know the basic theory.
Yeah.
A share is valued where willing sellers meet willing buyers.
Yeah.
But how does speculation, the actions of the bulls and the bears, how does that actually stabilize the market? Because it feels like it should do the opposite.
I know speculation often gets a bad name, but it performs this vital counter-cyclical function. A bull is someone who buys because they expect the price to rise. They're optimistic.
And a bear sells because they expect it to fall. They're pessimistic.
Exactly. Or they sell short. Now, how does having these two opposing forces actually smooth out the volatility?
I'm not sure.
Well, let's imagine there's a sudden, unexpected drop in market prices because of some bad news. If the market was only made up of long-term passive investors, it might just crash because nobody would step in to buy.
They'd all be selling or holding.
Right. But as the price falls, the speculators, the potential bulls, they start to see the lower price as an attractive, maybe undervalued opportunity. So they're buying, which is driven purely by the hope of making a future profit, actually puts a floor under the market. It arrests that steep decline.
It provides a safety net.
A vital safety net. And conversely, the bears provide a constant supply of shares. Even in a surging, maybe overvalued market, the bears are willing to sell because they think the price is just unsustainable. Their selling pressure helps to dampen the upward momentum.
So they stop bubbles from getting too out of control.
They help to. Speculation really ensures two things. First, high liquidity. There's almost always a buyer and a seller, no matter what the market sentiment is. And second, it reduces those extreme, aggressive price swings that might otherwise scare off the big, long-term institutional investors. Even though their motive is pure short-term profit, the result is a more robust and stable market for everyone.
Okay, now we are arriving at what is, I think, the most theoretically challenging and you could argue the most important conceptual part of this whole chapter.
I would agree.
Financial market efficiency and the efficient market hypothesis, or EMH. This really dictates the theoretical reliability of, well, every calculation we do later on.
This is the anchor for the whole discussion. We have to start with the ideal. So an efficient market is defined as one where the price of all traded securities reflects all available information relevant to its value.
All available information.
All of it. Now, there's a related but slightly different concept called a perfect market. That's one that responds instantaneously and without any cost to any new information.
That sounds like an economic theorist's dream. So if the market is truly efficient and perfect, what's the big advantage for the financial manager?
Reliability. It means the share price you see on the screen is the absolute fairest reflection of the company's true value, and that includes its current profitability and all its future prospects.
And if you can trust the price?
Then you can derive a reliable cost of equity, which is a key input for your WACC. If the market is perfectly efficient, the price is the fair price. The required rate of return you derive from it is the correct discount rate for your projects. If the market is inefficient, your WACC is basically built on quicksand.
Okay, so let's meticulously break down the 3 levels of the EMH. This is where the examiners really test your depth of understanding, isn't it? Not just the definition, but the precise consequence of each level.
Absolutely. We start at the lowest level, the lowest threshold, which is weak form efficiency.
Okay.
This level states that the current share prices reflect all the information that is contained in the record of past prices and trading volumes.
So just historical data. What's the punchline there for an exam candidate?
The consequence is this. If weak form efficiency holds true, it should be impossible to generate abnormal returns just by analyzing historical price patterns.
You can't beat the market by looking at charts.
You can't. The idea is that prices follow a random walk. Tomorrow's movement is completely independent of yesterday's. So, technical analysis, which relies on charts and historical trends to forecast future prices, it should fail to give you superior returns consistently.
So if you see someone making a fortune just by finding a head and shoulders pattern on a chart,
Then you know the market is not even weak form efficient.
okay, moving up a level. Semi-strong form efficiency. This is the one that a lot of financial theory seems to just assume is true.
It is. It's often the default assumption. And semi-strong efficiency raises the bar dramatically. It states that share prices reflect all information that is currently publicly available.
So it's a huge amount of data.
It's vast. We're talking annual reports, press releases, analyst consensus reports, macroeconomic forecasts, general news, everything that's out there in the public domain.
So the moment a company publishes its fantastic annual results, the price should instantaneously adjust to reflect that good news.
Precisely. And the critical implication here is that if the market is semi-strong efficient, no investor can make abnormal profits just by using publicly available research. All the value in that research is already in the price.
So price changes only happen when genuinely new information is published.
Exactly. If you want to outperform the market consistently, you must have information that has not yet been published.
And that leads us directly to the highest level, which is where we start to cross a legal line. Strong form efficiency.
This is the theoretical peak. Strong form efficiency asserts that prices reflect all information relevant to the company, both published and unpublished.
So private information too.
Everything. The market somehow already knows it all. It knows management's private strategy. It knows their future performance projections before they're even announced.
So, if this were true, the secret knowledge of an impending takeover vid, known only to the CEO, would somehow already be reflected in the share price. Even insider dealing would be pointless.
That is the theoretical conclusion, yes. And this is the critical examiner focus point. We know that there are very strict laws all over the world to outlaw insider dealing. Why?
It just works.
Because people can still make abnormal gains using unpublished information. Therefore, the practical conclusion, the one you must write in the exam, is that the stock market is, at best, only semi-strong form efficient.
It's never truly strong form efficient.
Never. Because that private unpublished information still holds value.
Okay, that distinction is vital. Now let's step away from the theory for a moment and look at the real world. The operational challenges for a financial manager when markets are, as they inevitably are, less than perfectly efficient. This is where the application marks are.
This is where you win them, yes.
So first application, the timing of new issues of shares or debt.
Okay, so if the market is a bit sluggish, or it hasn't yet fully absorbed all the public data, meaning it's less than semi-strong efficient, a clever manager can exploit that timing.
How so?
Well, imagine the manager knows that a major new product launch is scheduled in 6 weeks, and they know it's going to significantly boost future profits. But the market right now is unaware of just how successful it's going to be.
Yeah.
They could strategically issue new shares today, raising capital at what is effectively a slightly undervalued price compared to what it will be in 6 weeks when the good news breaks.
And that benefits the existing shareholders.
It does, because the company raises the capital it needs more cheaply, which means diluting their ownership less for the same amount of cash. It's a powerful advantage of inefficiency.
Okay, second implication. This one hits right at the heart of the FM syllabus. Project evaluation and the WACC.
Yes. If we can't trust the current share price because of market noise or inefficiency,
Then our calculated cost of equity is potentially wrong.
exactly. The required rate of return that's implied by that unfair share price is corrupted. And this makes deciding on the correct discount rate The WACC for evaluating multi-million-dollar projects incredibly difficult.
It's a huge problem.
It's an enormous practical problem. If the market is inefficient, our WACC, which is the cornerstone of our entire NPV analysis, might lead us to reject profitable projects, or even worse, accept value-destroying ones.
Inefficiency also creates an opportunity for deception, allowing things like creative accounting to work.
It does. If a market were instantly and perfectly efficient, management would have zero incentive to massage the accounts.
Why not?
Because investors would immediately see right through it. They'd look past the superficial numbers and accurately price the stock based on the true underlying profitability. But because real markets are slow, or semi-strong at best, managers can successfully mislead investors about the company's financial health, at least for a while.
And that can lead to an artificially high share price.
Which is a huge incentive.
Okay, final application here. Mergers and takeovers. How does market efficiency affect them?
Well, in a world of perfect efficiency, the target company's shares are always accurately valued. So if an acquirer comes along and pays, say, a 30% premium over the current share price,
They're basically paying 30% more than the company's actually worth.
they are, unless that premium can be justified by significant post-merger cost savings or revenue enhancements.
The famous synergies.
The fabled synergies, economies of scale, getting rid of duplicated departments, and so on. The logic is, if the market is efficient, the price is fair. Therefore, any takeover premium you pay has to be covered by those quantifiable synergy benefits. Otherwise, the acquisition is destroying value for your own shareholders.
But if the market is inefficient, then the acquirer might simply be taking advantage of a fundamentally undervalued target company. And the premium doesn't need to be justified by synergy alone. It's justified by buying an asset for less than it's truly worth. This is why understanding EMH is so important. It's the hidden assumption behind almost everything we do in finance. Let's pivot now to the other side of the balance sheet, to the debt side of the financial environment. This is all governed by interest rates, risk, and the yield curve. Understanding the cost of debt is just as crucial as understanding the cost of equity.
Absolutely. Fundamentally, an interest rate is just the price of money. The most obvious driver is the general level of interest rates in the economy, which is largely set by the central bank's monetary policy.
Right.
But beyond that base rate, we have to factor in risk and duration.
The classic risk-return trade-off. It applies here just like everywhere else.
Of course, higher risk demands a higher return. An investor lending money to, say, a government via a treasury bond, which has almost zero default risk, will accept a very low interest rate.
But if they lend to a startup,
If they lend to a startup or a company with a shaky balance sheet, they will demand a significantly higher rate. That's the risk premium. It's to compensate them for the much greater chance of default. A financial manager needs to know where their company sits on that risk spectrum.
another critical factor is the duration of a loan. Let's assume a stable economy. Generally, the longer the term of the loan, the higher the interest rate will be. Why is that?
It's direct compensation for increased risk and uncertainty. Over 5 years, a company's creditworthiness could deteriorate, the economy could change dramatically, inflation could eat away at the real value of the repayment.
So lending for 20 years is just inherently riskier than lending for 6 months.
Far riskier. The lender demands a higher rate to offset that compounding risk over a longer period of time.
And the final factor is volume, right? Sometimes bigger loans get better rates.
That's true, yes. There are administrative efficiencies. Handling a single $100 million loan is less complex per dollar than processing 1,000 individual $100,000 loans. And those administrative savings are often passed on in the form of slightly better rates for large corporate borrowings.
All of these factors come together to create what we call the term structure of interest rates, which we visualize with the yield curve.
Yes, the yield curve. It just plots the yield, or interest rate, of debt against its time to maturity. It's a snapshot of the market's expectation of the future cost of money.
And the shape of that curve is a vital signal for a manager.
It's a massive signal. It gives you a real-time indication of where interest rates are likely to go in the future, which directly helps the financial manager choose the right source of finance.
So, should we lock in a fixed long-term rate now because we think rates will rise? Or go for flexible short-term debt because we think they'll fall?
Exactly. The yield curve is the map that helps you make that choice.
Okay, let's dig into the three theories that try to explain why the yield curve takes its different shapes: normal, flat, or inverted. First, the most intuitive one, expectations theory.
Expectations theory is pretty straightforward. It says the shape of the yield curve is determined entirely by the market's collective expectation of what future short-term interest rates will do.
So if everyone thinks rates are going to go up for the next few years,
Then they will only be willing to buy a long-term bond today if that bond offers a higher yield to compensate them. And that creates an upward sloping or a normal yield curve.
and if the curve is inverted, so sloping downwards, where short-term rates are higher than long-term rates.
That's a signal that the market expects short-term rates to fall sharply in the future. It's often interpreted as a sign of a coming economic slowdown or recession.
So the takeaway for the manager is direct. If the curve is steeply upward sloping, the market is basically screaming, rates are going up.
It is. And the FM should be thinking about issuing fixed-rate long-term debt sooner rather than later to lock in the current lower costs.
Okay, theory number 2, liquidity preference theory. This seems to build on that idea we just discussed about compensation for tying up your cash.
It does. This theory argues that even if investors expected future interest rates to stay completely flat, so a flat expectations curve, they would still demand a higher yield for longer-term securities. Because investors have an inherent preference for liquid assets, they prefer cash or short-term bonds that can be sold easily.
So the longer I have to lock my money away, the greater the inconvenience, the greater the opportunity cost I suffer.
Precisely. So to persuade an investor to defer the use of their capital for a long time, the issuer has to offer them a premium, a liquidity premium. And this preference naturally pushes long-term yields higher than short-term yields. It helps explain why the normal shape of the yield curve is upward sloping.
Okay, and finally we have segmentation theory. This suggests the interest rate market isn't just one big, unified pool of capital.
That's right. Segmentation theory argues that the market is divided into distinct segments based on maturity, and that different groups of investors and borrowers are only active in their preferred segment.
For example.
For example, big pension funds might focus almost exclusively on long-term securities because they need to match their long-term liabilities. But commercial banks might focus heavily on short-term lending and borrowing to manage their daily liquidity.
So the supply and demand of the short-term market could be completely separate from what's happening in the long-term market.
Exactly. And the shape of the curve is then influenced by the supply and demand pressures within each specific segment. If demand for short-term debt suddenly spikes because of high bank activity, the short-term rate will rise, maybe independently of what's happening at the 10-year mark.
And that can cause weird shapes in the curve.
It can. It can cause discontinuities that neither expectations nor liquidity preference can fully explain on their own. The FM needs to be aware that rates in their required segment might be temporarily inflated or suppressed because of these localized supply and demand issues.
It's vital we bring this whole discussion right up to the modern day, because the financial landscape is changing so fast. We have to talk about fintech and the emerging risks it presents. This feels like very fertile ground for written exam questions.
Oh, absolutely. Fintech, or financial technology, simply means using technology to deliver or improve financial activities. And while, internet banking is an example, the real deep dive here is on the disruptive elements.
You mean the new operators that challenge the old system?
Yes, the ones that often bypass the traditional intermediaries completely.
Things like peer-to-peer lending, instant money transfer services, online share trading platforms, crypto.
All of that. They are fundamentally changing how capital moves around the world.
And that change brings huge advantages.
Undeniable advantages. The primary benefits are significantly lower operational costs, which means lower fees for users. We also see near-instant access to services and transactions, which boosts efficiency. And critically, fintech injects this massive dose of competition into the financial system, which forces the traditional, often slow-moving banks to innovate and drop their prices.
It sounds overwhelmingly positive for corporate finance, faster, cheaper access to everything. But the financial manager has to be able to talk about the significant flip side, the emerging dangers. What's the biggest technical concern?
The immediate number one technical danger is the security threat. When money is flowing instantaneously across global, often decentralized networks, the sheer volume of business being done entirely online creates an exponentially increased vulnerability to hacking, data breaches, and cybercrime.
Right.
Robust security is no longer a luxury. It's a fundamental operational cost. A single major breach can destroy trust and value instantly.
And beyond the technical security, there's the regulatory gap. Traditional finance is covered by decades of regulation. Fintech often operates in a gray area.
And that gap creates what we call regulatory arbitrage. New operators can get a competitive edge by setting up where regulations are weakest. And this leads to huge concerns over consumer protection and major systemic risks like money laundering.
How so?
The speed and the anonymity offered by some of these digital finance methods can make it much easier to convert illegal funds into supposedly legal money, especially if the regulation isn't keeping pace with the technology.
So the financial manager isn't just enjoying the speed and low cost. They have to factor in higher compliance costs and the risk of regulatory scrutiny. To ask, is the lower transaction cost worth the higher security and compliance risk?
Exactly. And in a written exam, you must show that balanced judgment. Acknowledge the efficiency benefits, but also be able to articulate the specific regulatory and security challenges.
Okay, this whole deep dive has really reinforced the central idea. The environment isn't a footnote. It's the source code for the financial manager's big decisions. Let's try and synthesize those decisions now.
Everything connects back to those two foundational tasks we started with. First, determining the appropriate cost of capital, the WACC for investment appraisal. That calculation relies completely on the assumptions we make about market efficiency and the risk drivers in the economy. If the market is unreliable, your WACC is unreliable.
And the second task, choosing the optimal mix and timing of finance.
Yes. And this involves strategic decisions linked directly to the structure of the capital markets. Do we use AIM or the official list? It's about understanding the cost differentials driven by intermediaries, and critically, it's about interpreting the yield curve to decide if short-term debt, long-term debt, or equity is the best choice at this precise moment.
So mastering the environment is what gives the manager the tools to manage risk and get capital at the lowest effective cost.
That's the end game, yes.
Now for the final, absolutely critical piece of advice, based on our experience as tutors, avoiding vague answers. This is where so many students lose easy marks on the written questions in FM.
It is the single most common failing I see. Candidates will give these generic, descriptive answers instead of precise, applied analysis. You have to show intellectual rigor. You have to explicitly connect the fact or the theory to the consequence or the managerial action. The examiner needs to see you using the specific terminology.
Okay, give us a few really precise examples of how to phrase that application, linking the environment to a strategy.
All right. First one, on inefficiency. Never just say, managers can timeshare issues if the market is bad.
Too vague.
Far too vague. Instead, say something like, the market exhibits signs of being less than semi-strong efficient. This allows management, who possess unpublished information about an impending regulatory approval, to strategically time a new share issue just before that positive information is released, thereby capitalizing on the temporary undervaluation for the benefit of existing shareholders.
That is a huge leap in quality. It uses the exact EMH terminology and links it to a specific action and outcome. What about an example on debt duration?
Don't just say, a long loan is riskier. Say, the extended duration of the proposed 15-year debenture necessitates a higher interest rate because the increased time horizon magnifies the uncertainty regarding the company's future creditworthiness and its overall default risk, thus requiring a higher risk premium from the lender.
Perfect. It defines why the rate is higher. Finally, how do we apply that precision to the yield curve theories?
Okay, if you're discussing debt issuance when there's a steep, upward-sloping yield curve, avoid saying, the manager should borrow long now.
Right.
Instead, state, under the expectations theory, the steep upward slope of the yield curve signals that the market anticipates future interest rate increases. Therefore, the financial manager should strategically prioritize issuing fixed-rate, long-term debt today in order to hedge against the projected increase in the cost of short-term financing over the coming years.
Structure your answers, apply the concepts, and explicitly link those precise definitions to the scenario in the question. That is the key to passing this chapter.
It is, and that brings us to the overarching conceptual challenge of the entire FM syllabus, really. A final thought for you to take away.
Go on.
If we accept the practical reality that the stock market is, at best, only semi-strong efficient, what does that really mean for all the complex valuation techniques we cover later on? I'm talking about models like the capital asset pricing model and the WACC itself.
Which all rely on the assumption of efficient pricing.
They fundamentally rely on it. So what happens to the practical reliability of those complex numerical models if we know that real-world markets consistently fall short of that benchmark?
That's a very deep question worth pondering as you move forward into the heavy calculation chapters. A good reminder that finance is an art built on shaky, but very necessary assumptions.
Absolutely.
And that brings us to the end of today's comprehensive deep dive into the financial management environment. If you found this discussion valuable for your exam preparation, we really encourage you to go deeper.
You can subscribe to the SmartPass YouTube channel for full ACCA exam-focused deep dives and explanations. They cover the entire syllabus and seamlessly link these conceptual chapters to the detailed calculations that come next.
And for daily exam tips, revision strategies, and updates tailored specifically for the ACCA student, be sure to follow the SmartPass Instagram page. The link is right below this episode. Thank you for joining us, and we wish you the very best in your studies.